Welcome to the Deep Dive. We're talk tickers, and we boil down complex earnings calls so you get the crucial insights fast. Today, we're digging into Workhorse Group's Q2 2025 earnings call. And this was definitely more than just a numbers update. We saw some really big strategic moves, especially that merger agreement they announced, all happening against, well, a pretty complex financial picture. Our mission today, to unpack what it all means for you.
Yeah, and it's a critical time to be looking at this. The commercial EV space, I mean, it's incredibly high stakes.
Yeah.
Very capital intensive, and we've seen some major shakeups recently. I think Lordstown, Fisker. It puts Workhorse's moves, especially this merger, into sharp focus. These decisions are absolutely pivotal.
Okay, so let's jump right into those headline numbers first. Workhorse reported a GAAP EPS loss of $1.67 for the quarter. Now, that's a loss, obviously, but here's the kicker. It actually smashed the consensus estimate, which was way worse at a 3.98 cents loss. And revenue came in at $5.67 million. Again, blew past the $2.3 billion consensus. That's, what, a 573% year-over-year jump, their biggest quarter ever for revenue. So beats on EPS and revenue. Sounds good on the surface, right?
Well, yeah, those top-line numbers definitely grab your attention. Shows a real ramp-up in sales activity. But you really have to look underneath that. The critical piece is the gross margin. Deeply negative, minus 130%. So think about it. For every dollar in sales, they're losing $1.30 just on the cost of the goods they sold. That works out to a gross loss of about $7.4 million on those $5.67 million in sales. It just shows the unit economics are, well, very unfavorable right now. It makes getting to actual profit a really steep climb.
Wow, minus 130%. Okay, so selling a lot more, but costing them a lot to do it. Still, they did manage some operational improvements, didn't they? SG&A costs were down.
Yeah, SG&A dropped by about $6.3 million compared to last year, and R&D was down slightly too by $6-7 million. So they are tightening the belt in some areas.
And actually shipped trucks, right? Made some real progress there.
They did. Shipped 32 of the W56 trucks in Q2, and they also locked in 36 new purchase orders. That shipment number was a record for them. More trucks shipped in this one quarter than in all of 2024 combined.
Okay, so that's tangible progress. Getting trucks out the door, finding buyers.
Definitely positive signs on the operational front. It suggests there's demand, even if the cost structure isn't working yet. The big question hanging over everything is, can they keep this momentum going and fix those margins? That's really where the rubber meets the road.
And that leads us straight to the biggest news, doesn't it? Just before the call, they announced this definitive all-stock merger agreement with Motiv. It aims to create a combined company worth around $105 million. They're targeting a close in Q4 this year, assuming Workhorse shareholders approve. This feels less like a pivot and more like a really high-stakes gamble to kind of reset their position.
Oh, absolutely. A very high-stakes move. And you have to understand the financial impact on current Workhorse shareholders. It's significant. So Motiv's main investor, they're set to own about 62.5% of the combined company. Then Workhorse's senior lender gets rights to acquire roughly 11%. That leaves the existing Workhorse shareholders with only about 26.5%. That's major dilution.
Right. And that probably explains a lot of the market's initial sort of hesitant reaction.
Exactly. It's a huge factor in how investors are looking at this deal. Who really controls the company going forward changes quite a bit.
And to make this happen, they've taken steps to get some cash in the door, right? Some liquidity actions.
Yeah, they did two main things. A $20 million sale-leaseback on their big manufacturing plant in Union City, Indiana. And they also secured a $5 million convertible note, which is basically short-term debt.
Okay, so getting some immediate cash to keep things running and maybe pay down some existing debt before the merger closes, trying to clean things up.
That seems to be the plan. Simplify the capital structure a bit. And looking ahead, post-merger, the plan is for the new company to get access to potentially another $20 million in debt from Motiv's controlling investor. That's split $10 million as a revolving credit line and $10 million specifically for manufacturing costs, like an ABL facility. But, and this is important, they also explicitly said they'll need to seek more funding for 2026 and beyond.
Okay, so this current funding is really just a bridge. More capital raises are likely down the road.
Seems that way. It signals the long-term plan still requires significant investment.
All right, let's talk about the vision here. What are they hoping to gain by combining, besides just the cash infusion? They mentioned synergies.
Yeah, they're targeting at least $20 million in cost savings by the end of 2026. That's what's come from combining R&D efforts, consolidating G&A, administrative stuff, and maybe facilities. They also talked about using common software and hardware across the different truck classes, class 4 up to 6, to try and lower the cost of parts, the bill of materials, and make servicing easier.
Okay, $20 million in savings sounds good. But realizing synergies in a merger, that's always easier said than done, isn't it?
Always the challenge. Integration is tough, especially in manufacturing. But, one interesting angle here is something Workhorse does uniquely well. They're apparently the only OEM in North America that can build its own strip chassis completely from scratch.
The bare frame of the truck.
Exactly, before the body goes on. If they can leverage that capability effectively with Motiv's operations, they think they can drastically cut the time it takes to upfit a truck, put the final body on, from maybe 9 or 12 months currently, down to less than 6.
Wow, okay. That would be a big deal for getting trucks to customers faster, especially large fleets.
It could be, yeah. It highlights a potential operational synergy that goes beyond just cutting costs. Real efficiency gains.
And the combined company will have a broader product lineup too, right?
Definitely. A full range covering class 4, 5, and 6 trucks. And crucially, it brings in Motiv's expertise in things like school buses and shuttle buses. That's a whole new market segment for Workhorse.
They also mentioned progress on the W56 truck, the 140 kilowatt battery version.
Yeah, durability testing is done on that one. They're aiming for over 100 miles of range with a full payload. Production is slated for early 2026. And they also made a point of saying the Utilimaster Aeromaster body, which is pretty popular, is now available to order on the W56. So expanding options.
How are they planning to sell all these different vehicles? Selling commercial EVs isn't straightforward.
No, it's not. They talked about a team sell approach, basically combining Motiv's way of doing things, which is more direct, consultative, focused on building big relationships with large fleets, with Workhorse's existing national dealer network. They have, 19 dealers covering all states?
Right. So using both direct sales and dealers.
Yeah, the idea is to guide these large fleets through a kind of 4-step process. Start with a small pilot program, then an initial order, then move towards multi-year contracts for potentially hundreds or thousands of trucks.
A structured approach to land those big fish, essentially.
Exactly, trying to de-risk the process for the fleets and build long-term volume.
And all this is happening, as we said, in a really tough market. Capital intensive, we've seen failures. It's a risky space.
It really is. And, one of the persistent problems for Workhorse, talking to potential large customers, has been the perception that their balance sheet was just too risky for a startup. Fleets worry about ordering hundreds of trucks from a company that might not be around in 5 years to service them or honor warranties.
Right, the financial stability concern.
Precisely. Yeah. So this merger, and specifically the backing from Motiv's investor, is meant to directly address that concern. The hope is that a stronger-looking balance sheet will make those large fleets more comfortable placing significant orders that might have been on hold. It's about building confidence.
And government help still matters too, I assume? Things like the California HVIP program.
Oh, definitely. Those incentives are still really important, especially in the near term. HVIP offers, I think, up to $85,000 for a class 5 or 6 truck in California. Even more for small businesses.
That makes a big difference in the upfront cost.
It does. But the company with clear management emphasized that the long-term goal, the real strategic aim, is to get to cost parity with diesel and gasoline trucks without needing those vouchers.
Achieving TCO, total cost of ownership parity.
Exactly. That's seen as the key to mass adoption. Making EVs the clear economic choice on their own merits. That's the real brass ring everyone's reaching for.
Okay, so we've got the strategy, the numbers, the context. What did investors make of all this? How did the market react during the call?
Well, the immediate reaction wasn't exactly celebratory. Workhorse shares actually drifted lower throughout the call. They ended up closing down almost 10% for the day, landing at $1.45.
So even with the revenue beat and the strategic merger news, the market was cautious, maybe even skeptical.
I think that's fair to say. Cautious constructive might be the kind way to put it. It suggests investors were weighing the positives against some pretty significant risks.
What risks were they focusing on, do you think?
Well, you see this divergence, right? Management is talking up synergies, the pipeline, the strategic fit, but the market seems more focused on that big dilution number for existing shareholders, those persistently awful gross margins, and just the general execution risk of pulling off a complex merger integration smoothly.
Plus, the company does have a history, right? Multiple reverse stock splits recently.
Yeah, in 2024 and 2025, that history definitely forms part of the backdrop and contributes to the skepticism. Yeah. It's become a real show-me story for investors. They need to see proof.
So if it's a show me story, what needs to happen? What are the catalysts we should be watching for that could actually change sentiment and maybe lead to a re-rating of the stock?
Okay, several key things. First, obviously, they need to get the shareholder approval for the merger and close the deal, hopefully in Q4 as planned. That's hurdle number one. Then we need to see tangible updates. Are they actually hitting those synergy targets? Are unit costs starting to come down? We need milestones.
Proof points, basically.
Exactly. Then, evidence of actual orders converting. Are they getting repeat business? Are large fleets signing those multi-depot deployment contracts they talked about? And finally, successfully getting that post-close financing sorted out cleanly. They need to show they have the capital runway to execute the plan.
So ultimately, it comes down to showing real improvement in those gross margins.
I think so. Sustainable improvement driven by scale, better purchasing power, real efficiencies, plus clean financing and proof the sales strategy is working. That's what the market needs to see for a sustained re-rating.
All right, let's shift gears. It's time for our segment where we toss around an idea that might seem a bit out there, but, maybe has a sliver of plausibility. Remember, folks, this is not financial advice. So what's the outrageous but plausible trade idea for Workhorse today?
Okay, so this one is definitely speculative, highly conditional, probably a small allocation if you were to even consider it. The idea, a potential long position in Workhorse Group, ticker WKHS. Now, the outrageous part is pretty obvious, right? You're betting on a company that's undergone massive dilution, still has those deeply negative gross margins we talked about, and operates in an industry littered with failures. Fisker, Lordstown, you name it. It's betting against some serious historical headwinds. High risk, no doubt.
Okay, that's the outrageous part. Where's the plausibility? What has to go right for this bet to even make sense?
The plausible part absolutely hinges on flawless and rapid execution of this merger integration. Specifically, you're betting that the combination of the potentially stronger balance sheet plus the team sell strategy can quickly turn their claimed robust order pipeline into actual large-scale fleet orders hitting the books. The trigger, the thing you'd need to see as confirmation, would be visible, tangible proof of gross margin improvement in, say, their Q1 2026 earnings report.
So seeing those $20 million plus synergies actually start dropping to the bottom line, lowering unit costs.
Exactly. Seeing signs they're genuinely moving towards that cost parity goal with traditional trucks. It's a pure bet on strategic vision, meeting perfect execution, overcoming all that negative history. It's the ultimate show-me story playing out successfully. Needs patience, high-risk tolerance.
Got it. A long shot hinging entirely on execution and proof in the numbers. So let's wrap up this deep dive. Workhorse, clearly at a crossroads. This Motiv merger is a massive strategic shift, aiming for scale, stability. But it comes after a Q2 report that was, mixed, and the market seems pretty skeptical for now.
Yeah, the core challenge is crystal clear. Can this new combined company actually integrate smoothly, hit those aggressive synergy numbers, and fundamentally fix the unit economics? Can they get to cost parity? That's the billion-dollar question, really.
So as Workhorse and Motiv try to carve out a dominant space in commercial EVs, you have to wonder, will this combined strength finally unlock the sector's promise? Or will the weight of past issues, the dilution, the negative margins, keep holding them back? It's ambition versus some pretty harsh economic realities.
And just a final reminder, everyone, this deep dive was purely for informational purposes. Please, always do your own thorough research and due diligence before making any investment decisions.
Absolutely. Well, thanks for joining us here on the Deep Dive for this look at Workhorse Group. We'll catch you on the next one.